Hello traders, today we will take a closer look at the concept of the CFD itself. We will check the history, the way it functions, and of course summarize their advantages and disadvantages. So grab your favorite drink and let's start the video. So, contracts for difference are one of the derivatives products. It allows you to exchange the difference between the present price of the underlying asset and the price when the contract is closed. And they are in some way similar to options and futures. They're letting you make exposure both on long and short trades. And the underlying asset can be currencies, commodities, or indices. So, taking into account the asset class variety, adding up affordable pricing, that makes us perfect instrument for short-term trading. And its popularity is also the effect of regular volatility and liquidity, which eventually led to development of various short, mid, and long-term strategies. Okay, very briefly about the history. Probably I will not surprise you that the CFDs were developed on the London Stock Exchange in the 1980s by market maker Smith New Court. But did you know that the electronic form of the CFDs, as we know today, was launched in the 1990s by Gerard and National Intercommodities? Going further, when explaining the function, we need to refer to the name itself, which is a contract, right? It occurs between a buyer and a broker or other selling institution to exchange the difference between the purchase price on the contract and the price at which the contract is closed. And all it happens without the need of actually exchange the asset. CFDs are traded on margin, in which, in comparison to the other instruments, are relatively low. Thus, it gives the possibility to operate large positions without having a huge capital. Continuing explanation, I want to show you examples of trades. And in a long CFD trade example, a buyer could use a margin account to purchase 10,000 CFDs on an underlying asset trading at $4.20 to obtain a position worth of $42,000. And if the asset price rises to 4.50, the contract can be closed at a position worth of $45,000, offering a gross profit of $3,000, which broker have to pay to the investor, of course. However, if the price falls to $4, for example, the trade will produce a loss of $2,000. And in this case, the investor needs to pay the broker from his account. And it goes the other way with the short trade. As you can deduct from the construction of the product, it is useful for short-term trading to capitalize quickly on rapid market price changes. And the traditional buy and hold investing is designed for longer time frames. If a market unexpectedly rallies or crashes, CFDs are the best tool to get on the trade. So now we swiftly move on to summarize the whole video. Let's start from the good things about the CFDs, which are the first, leverage, because it allows you to enter the market with a lower amount and conduct a large trade which can maximize your capital efficiency. It can allow you to use trading strategies that were previously unavailable due to high capital requirement. The second thing are tax benefits. Tax situations differ in every country, but in many of them there are big benefits like tax-free profits from CFDs, or any loss incurred on CFDs can offset your capital gains taxes. Now turn for disadvantages. Here we must say about the dark side of leverage, which can work on your behalf when making huge profits, but when things are not going in our favor, it can be deadly to our account and stop us out of the market when we use it too much. Another downside are costs of the transaction, meaning spread and commission to the broker, taxes which we mentioned, and overnight financing costs. For each day you leave your position open, you may need to pay an interest according to the value of the contract. The last thing are execution risks. Normally it doesn't happen, but when you trade on very high volatile day, a lag between the time when an order is placed and the time when order is executed can occur. Resuming everything I talked about CFDs, as any other financial instrument, it has its risks and advantages, and require from the investor to put time and effort to use it wisely. At the end, I leave you with one advice: learn more and practice twice as much. Knowledge is nothing without a practice. So guys, thank you for this video. Be sure to subscribe to the channel, hit the like button, notification bell, so you get notified when new video will come. And yeah, see you in the next one. Take care.